Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. I'm starting off this week by looking at the VIX, which is the volatility index for the S&P, ticker symbol VIX. And as I usually do each and every week, I've left my lines on the chart so you can see the accuracy of what was forecasted last week. And if I zoom in here, you'll see that this is the line that I drew last week, expecting the VIX to drop and move towards filling this gap that's right around the 20 mark right there. And once the VIX has filled the gap, my secondary forecast is that the VIX will bounce and start to go up. Now, why is that important? Well, the VIX, again, is a contrarian indicator to the S&P. So if the VIX is expected to drop, then we're expecting the S&P to rally. And I'm not expecting a big rally. I'm just expecting a rally enough to fill the gaps that are on the charts. And then long term, I'm bearish on the overall markets. There's a lot going on around the world between the Syrian refugee crisis, between China, between the oil markets and the volatility there. It's very important that investors stay very watchful of their accounts and making sure that they're protecting their positions either through stops or options of some sort, or maybe even just lightening up on positions to reduce the exposure to the downside. Now again, keep this VIX chart in mind, because if we're bearish on the VIX short term, remember, we're going to be bullish on the S&P. So with that, I'm going to go to the S&P and look at the spiders. That's the S&P 500 ETF. And here too, I've left my lines from last week, and I expected a bounce for the S&P to move up. We did move up this week. And I'm not sure if the spiders are going to come all the way back up to this horizontal line, which is role reversal resistance, mainly because there was a bearish engulfing pattern that occurred on Wednesday, and as long as the price stays below the high from that bearish engulfing pattern, then I'm expecting the S&P to drop. Again, the VIX will drop, maybe causing the S&P to move up just a little bit here, but I'm not expecting a major rally. So what I'm going to do is erase all these lines and redraw what I think is going to happen. I think we're going to go up again to retest this high right here, and then I think we're going to drop from that point, eventually moving lower in the overall market. So I'm going to leave that in place. I'm not going to complicate the chart with many other lines. This is simple enough. And then next week we can come back to see whether or not this forecast is accurate. We've been 100% accurate for most of this year, and I'm going to continue to do my best to forecast in this way. So all you have to do is determine whether or not the market moved in this direction or not. I mean, it's really that simple. And if you're looking at the broad-based indices and you're an investor, at least you get some kind of insight as to what to do regarding risk management. That's the most important thing that you need to remember, is that charts, although they're a good forecasting tool, they should be used more for managing risk and cutting down on the possibility of you suffering a catastrophic loss. We don't want 2008 to happen all over again to you. We want to protect those profits and minimize the loss so that you have more working capital should the market correct and go down. Okay, let's take a look at the Russell 2000, more broad-based index, ticker symbol RUT. And as I zoom in here, you'll see that the market did bounce exactly as I expected it to. That's that V pattern that I drew. Again, it didn't complete the upward rally, but that's only because we have to give it more time. Each one of these candles is a day of activity. So if I leave this in place and just leave this line here, we still have another 4 days before it reaches the end of this line. So what I'm going to do is, again, erase and redraw so we have a clean slate to work with. And I'm going to draw this line as my downward short-term leg. That's just connecting those highs. And I'm going to project out here. And you can see that we have a short-term upward move here, almost as a triangle pattern. What I think is going to happen is I think we're going to move lower this way on the broad-based index, the Russell 2000, because things are looking more bearish than bullish in the overall markets. Like I said before, yes, I think we could see a little bit of a pop in the S&P, but ultimately lower. So I'm going to stick with a lower forecast for the Russell 2000, and then we'll check back on that next Saturday. Okay, finally, let's look at the diamonds. This ticker symbol DIA. It's the Dow Jones Industrial Average ETF, and I've left my lines there as well. We did get a little bit of a rally here, and then boom, the bearish engulfing pattern. So I'm going to erase this line. I'm just basically removing the drawing right there. I'm going to erase this line, and I'm going to erase this line. I'm going to leave the other lines up here, and let me explain what those are. This horizontal line is a gap fill right here. That's where the market would have to go to fill that gap. And then once the gap fills, there's an 80% chance that the market will go lower. The fact that this bearish engulfing pattern showed up right here tells me that the sellers moved in on this day. So there's going to be a minor resistance point right here. Where does that leave us now? Well, like the S&P, I think we can go up just a little bit, hit that resistance, and then I think we're going to come back down from that point. So this is what my forecast is going to look like for next week. And I'm only projecting out maybe 4 to 5 days right here. Remember, the distance or the width of these candles allow me to calculate what that's going to look like over the next week. So I'm going to leave that right there. And finally, the market guys pride themselves on financial education and providing the best in the world. And if you're interested in learning more about some of the things I've spoken about regarding gaps and resistance and role reversal and such, just go to themarketguys.com, click on the video tab right there, and it will bring you to a library of videos, starting with fan patterns, and I even mentioned the call option just to give you a brief explanation of what options might look like for you there. We have other types of patterns and concepts. We have the 1% rule, which I think is the most important video here. It's about 7 minutes long. Talks about how to manage risk using a very simple math formula. And then, of course, trading the gaps, which is one of the most accurate ways to look at a chart and trade with a strategy that works about 80% of the time. So if you're right 80% of the time and you know you're going to be wrong 20% of the time, all you have to do is minimize the loss during the times that you are wrong, and that leaves more capital in your account to be able to trade and make money with what remains. And it's pretty simple. It's basically simple math in playing the numbers. You just have to control your emotions, use the charts to help you make the decisions, and that's about it. I'm AJ Monty, Chief Market Strategist with The Market Guys. Have a great rest of the week. So long.